Palantir Technologies trades at approximately $175 per share for a market value of $420 billion. At that price, our reverse DCF implies approximately 34.1% annual unlevered free cash flow growth for the next 10 years. That price-implied path takes estimated unlevered free cash flow from $3 billion today to $58 billion in year 10, 19 times the current level. Over fiscal 2022 to 2025, reported free cash flow grew by 125.3% per year. That is the delivered record beside the price-implied 34.1% annual growth path. So is this a conservative assumption or a scale that demands unusually durable execution? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses, one conditional verdict. We model Palantir Technologies' cash engine as customers to ARPU to gross margin to free cash flow. The template's proposed defense is switching costs. Once a company runs its operations on this platform, ripping it out costs more than staying, and that is what protects the margin. For an upside case to hold, three things must be supported: seat growth, pricing power, and margin discipline. We will test each one later. Palantir Technologies' stock has materially outpaced the market. That helps explain investor enthusiasm, but not whether the current price is justified. Over the last 3 years, revenue grew approximately 32.9% a year, and reported free cash flow grew approximately 125.3% a year. Reported free cash flow margin moved from 9.6% in fiscal 2022 to approximately 54.6% for the latest trailing period. In the quarter ending June 2026, revenue grew 92.8% year over year, a clear acceleration from its recent trend. The question is whether that continues. You can see it on the chart. The stock materially outpaced the broader market over this period. That relative performance is useful context for the valuation, not proof of fair value. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered, it is what the price now requires. At the time of this analysis, Palantir Technologies trades at approximately $175 per share, for an equity value of roughly $420 billion. Estimated trailing unlevered free cash flow is approximately $3 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 10.1%, the company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. Palantir Technologies holds net cash of about $9 billion, so we solve against enterprise value rather than the headline market cap. The result, on these assumptions, today's price implies approximately 34.1% annual unlevered free cash flow growth over the next 10 years. The market's math under our assumptions, not a fact. Compared with recent growth of 84.1%, that looks conservative. But percentages mislead when the absolute scale matters, and the required growth remains demanding. Across reasonable discount rate and terminal growth assumptions, the hurdle stays high. That growth path takes unlevered free cash flow from $3 billion today to approximately $58 billion in year 10, 19 times the current level. Watch it compound. Year 1 already needs roughly $4 billion. By year 5, approximately $13 billion. Each year building on the last with no year off. That target has operational consequences. Holding the current estimated unlevered free cash flow margin at 40.1%, Palantir Technologies would need approximately $145 billion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery. But does our own forecast produce the same value? Now I forecast the business itself. $6 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 30% and fades toward 5%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion gives back a lot of ground in this path, from 50.3% of revenue today down toward 40.1%. With a 10.1% discount rate and 2.5% terminal growth, that produces $46 per share. That discount rate is a market value weighted average cost of capital built from a 4.7% risk-free rate, beta of 1.2, 4.5% equity risk premium, and 1.6% pre-tax debt cost. About 56.9% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 20.7% growth and assumes cash conversion never improves at all, holding at 35.6%. It is worth $29. The bull case starts at 35% and reaches 46.9%, the best margin it has ever posted. It reaches $62. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate. At $175, the stock sits above even our bull case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. Palantir Technologies trades at approximately 148 times trailing earnings. Based on expected forward earnings, that falls to approximately 75 times. The gap reflects the growth analysts already expect. The company's own median across 3 fiscal observations is approximately 265 times. The broader market trades at approximately 24 times on a configured trailing price to earnings benchmark. But notice the tension. On earnings, Palantir Technologies looks inexpensive, yet measured against the free cash flow it produces today, our model says the price still demands extraordinary long-term growth. Cheap on earnings is not the same as cheap on cash flow. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Seat growth is mixed. Revenue grew 92.8%, but the data does not isolate seat growth. Pricing power is mixed. Revenue growth of 92.8% and reported free cash flow margin of 54.6% do not isolate pricing. Margin discipline is supported. Reported free cash flow margin is 54.6%, 44.9 points above the oldest year. 1 of 3 is supported. Seat growth, pricing power remain unresolved. The verdict remains conditional. Now stress the model. The business risks are seat saturation, competitive pricing pressure, churn in a downturn. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $34. Second, reduce the steady state free cash flow margin by 20%. Fair value becomes $39. Third, raise the discount rate from 10.1% to 11.1%. Fair value becomes $40. Finally, combine all 3 while fading mature growth to the terminal rate. The model falls to $25. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there is one counter-argument this analysis owes you. One more test before the verdict, and it is the simplest here. At the growth rate we forecast, 17.2% a year, today's price says the company would have to turn 190.8% of revenue into free cash flow. It converts 50.3% today. There is no version of that. A company cannot turn more into free cash flow than it collects in revenue. And the growth rate is ordinary. It is the conversion that cannot exist. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here's the verdict. Lens 1, the reverse DCF. The price demands 34.1% growth every year for 10 years. A lower implied free cash flow path than the company's recent delivery, but not a guaranteed outcome. Lens 2, our own DCF. $29 in the bear case, $46 in the base case, $62 in the bull case, and the current price sits above even our bull case. Lens 3, the multiple, a clear discount to its own median across 3 fiscal observations. The combined downside case lands at $25, approximately 85.9% below the current price. Add the 3 together and the tension is subtle. The company has cleared comparable hurdles before, but past delivery does not guarantee the forecast period. Our own DCF still cannot reach today's price. Even the optimistic scenario falls short, with the base case roughly 73.6% below it. So what would have to be true for today's $175 to be right? Growth far above our bull case. closer to the 34.1% a year, the reverse DCF backed out. That distance is the expectation gap. Our overall verdict, priced beyond our bull case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot, August 25, 2026. Position not disclosed. The description lists sources, method, and AI use.